Well, U.S. natural gas prices attempted to move higher on Thursday ahead of the EIA weekly storage report, but the rally faded quickly after the report showed a draw that was 4 billion cubic feet smaller than expected. The muted reaction suggests that the market is not overly concerned about supply tightness at this point in the season. From a fundamental standpoint, traders appear confident that strong production will offset the current supply gap as we move deeper into the spring shoulder season, well before the high-demand summer cooling period begins. In addition, weather forecasts continue to offer little support. Warmer than normal temperatures are expected to dominate across most of the U.S. over the next 14 days, limiting demand growth and keeping pressure on prices. Recently, some market participants have raised concerns about potential military escalation between the U.S. and Iran and the possibility of a closure of the Strait of Hormuz. In theory, such a disruption could significantly impact global LNG flows. However, if traders were seriously pricing in that risk, we would likely already see a stronger upward reaction in U.S. gas prices, as markets tend to bid higher when uncertainty persists. A closure of the Strait of Hormuz would primarily impact Asian and European markets. Qatar, the world's largest LNG exporter, must ship its volumes through this choke point, which handles roughly 35% of global seaborne oil and LNG flows. European benchmarks such as TTF have already reacted to geopolitical headlines, as buyers scramble to secure supply in global spot markets. By contrast, the U.S. Henry Hub market is largely domestic and linked to pipeline exports to Mexico and LNG exports from the U.S. Gulf Coast. Only a portion of U.S. production is exported as LNG, and most major LNG export facilities are already operating near full capacity. From a physical standpoint, it is currently difficult to meaningfully increase export volumes. Nevertheless, because fundamentals are apparently optional in today's market, speculative positioning can move prices wherever it pleases. Large players can always choose to speculate on the latest geopolitical headline, sending prices sharply higher or lower even when the actual supply-demand balance hasn't changed one bit. From a technical perspective, the trend remains down based on both the swing chart and the moving averages. A trade above $3.30 would shift the short-term outlook higher, while a move below $2.92 would reaffirm the prevailing downtrend. Near-term resistance is clustered in the retracement zone between $3.30 and $3.50. The 50-day moving average at $3.27 continues to guide the market lower and act as resistance. A sustained move above this level would shift momentum to the upside, with the 200-day moving average at $3.73 as the next potential target. On the downside, the market remains vulnerable below $2.92. Earlier this week, we noted that a decisive break below the psychological $3 level could trigger either a sharp sell-off into the $2.80 support zone or a more gradual stair-step decline. So far, price action suggests the latter scenario is unfolding. However, once the anticipated cold front passes early next week, or if U.S.-Iran tensions escalate materially, volatility could increase and lead to a sharper move as we approach contract expiration. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.